It's Brian Mudd. This is my cheat sheet for December 4th. It's Tuesday. 21 days until Christmas. Okay, so yesterday I had the story on local real estate. Staggering price increases, 25% year over year locally. We have seen that the entire dynamic with local housing has changed considerably over the course of even the last several months, to where we've gone from the mid-single digit gains all the way up to the staggering year over year gains. But nationally, we continue to see the recovery underway too. And there's a national and a local trend that's a little bit instructive here. First, what we're seeing nationally is that the average lower priced home is selling for about 10% more year over year than the luxury counterparts that have appreciated by about 7%. 7.6%. We're also seeing a bit of that phenomenon in a much bigger and different way here locally. And the 25% year-over-year sales increase number that we saw coming out of October, what we saw was that single-family homes appreciated by 16%, but we actually saw a 46% increase among condos and townhomes that are on average priced at a much lower point than single-family homes. And here's what's going on nationally and what's going on locally. More and more people, specifically investors, are buying either second homes that they might use for season to look to rent out the property the rest of the time to pay, in effect, for their investment and their usage of this property, or they're just outright buying lower priced properties to rent out. We've talked about how people are hungry for yield, right? Because it's so hard to find it anywhere. You can't get it in fixed income. You have to take on a lot of risk in the stock market to get high yields there anymore. And, bonds, people getting into junk because they're desperate to find yield. I mean, it's so hard. But this is a really good way and a more stable way that you can obtain yield these days, to go out, buy several lower priced properties and be able to cash flow them positively. And that's exactly what you're seeing. And that's the reason that nationally and locally we are seeing that condos, townhomes, lower priced properties are appreciating at a far faster rate than the average property. Now, here's what's important about this. Let's say that you are interested potentially in move-up buying, but you thought you were trapped underwater in your home. When you're talking about prices that have appreciated locally 46% year over year, that's really, really staggering. Consider that top to bottom and the real estate decline, we ended up seeing locally that properties depreciated about 56%. That means that you've almost recovered top to bottom the worst in the average condo or townhome in our area. I know that sounds crazy. That's not the case of all of them. Some condos and townhomes in certain communities that are less desirable are nowhere close to having recovered on a percentage basis what they lost from the peak. And keep in mind that even if you did, the total average value of them would still be lower. But still, you've seen the average condo or townhome in our area go from about $130,000 to nearly $180,000 year over year. So you might be in an equity position. If you wanted to move up buy, it might be that opportunity. But maybe more importantly, if you're looking for yield, the opportunity to buy some of these lower priced properties and cash flow them the way that you're seeing nationally, it could be a smart thing. If you do that, though, word to the wise, talk to your financial advisor, and it might be important not to have a bunch of properties in one area. Let's say, for example, you had a bunch that were just here locally, and then a hurricane came. What would that do potentially to your cash flow situation? So you got to think diversification with real estate if you're going to do that, the same as you would with investments generally. All right, a couple things here real quick. How important that federal policy actually is to your pocket. We talk about the fiscal cliff and all of these issues in terms that make it sound as though it's some kind of thing and that it doesn't actually directly affect your pocketbook. Well, at this point you should know that everybody faces various tax increases come January 1st, regardless of what your income is. But let's talk about wealth creation in this country. Just how important is it actually? Well, Wealth Insight, which is a financial research firm, posted information yesterday that suggested that if we go over the fiscal cliff, we will have 316,000 fewer millionaires next year than we do right now. In other words, not only will we not be creating net new millionaires next year, but we'll be destroying the wealth of about 316,000 such that they're not anymore. The total loss among millionaires would be about $250 billion. Conversely, if we never had the fiscal cliff as a problem at all, in other words, if we had responsible government and we were just able to, look towards next year like a normal year, well, get this, we would create, in an average year, 440,000 new millionaires next year, and the overall wealth creation would be $1.6 trillion. So what you can see is that there is a difference of more than 600,000 millionaires between sound fiscal policy out of Washington and going over the cliff. And whatever the inverse reaction is in the middle here, based upon whatever might happen in Washington, it affects the ability to create wealth. And it's not just about millionaires. It goes all the way down the line, because to become a millionaire, you have to start somewhere, right? And that's the biggest thing. The irresponsible policy in Washington has consequences to all of us, and it's destroying the opportunity for us to have upward mobility and achieve the American dream. And that's just plain sad. And here's the next thing, and this is what I'm going to leave you with today. I am very close to embracing the fiscal cliff. Boehner's proposal yesterday, which is maybe as good as it would possibly get from actually a cost-saving standpoint, because remember, the single biggest problem here isn't squabbling over tax rates. It's the debt crisis that is looming, because if we rack up enough debt, we're going to have 27% unemployment like Spain just reported. Sorry, 27% in Spain. All right, it can happen. But the bigger issue at hand is that even his plan, if it worked exactly the way he said it would, well, we would still have $6 trillion in new debt over the next 6 years. And that's just insanity. So we've got dumb and we've got dumber in terms of policy. And they're going to negotiate on stupidity together. I'm not very optimistic. That's kind of sad. So I hate to leave you on that note, but you got to be smarter than ever and make it happen for yourself, because your government, they're working hard to destroy wealth. They're working hard to put us on a track that, I don't know, just take a look at Europe. All the fun over there. Cheat sheet for today. Be smart, make it happen for yourself, because politicians generally are dumb. We'll see you tomorrow.